Celsius is expected to report earnings, and they will do so Wednesday before market open. Just like Elf Beauty is expected to report earnings, however, Elf will report after the market closes. So let's go through the analyst expectations, because especially Celsius Holdings has a lot of question marks regarding their numbers. So let's take a look at the biggest issues these companies are facing, and with that I mean both of them, because also Elf is looking at some decent issues. But let's not waste any time and start by looking into Celsius Holdings, because Celsius Holdings has seen great growth over the past few quarters if we take out Q1 and Q2 of this year. Now, if we look at Q1 and Q2 of this year, we still see 37% and 23% revenue growth. However, this almost dwarfs compared to the 95, 104 and 112% revenue growth we have seen over the quarters prior to that. But if we look at Celsius, we can see that they are one of the few companies that has seen positive market share growth for 2024 if we look at it year to date. We can see in the table on the right side here that on the year to date 2024 market share, Celsius holds around an 11.4% market share, which is a clear number 3. But we can also see that they have by far gained the most market share out of any brand in this list. Now, we can also see the market share, and we see a difference here between Moolak and Mulo Plus. But before going into that, please, if you enjoy my videos, if you think my videos are educational, make sure to subscribe to my channel. I am now only 25 subscribers away of that first milestone of 1,000 subscribers. So please, if you enjoy my videos, make sure to hit that subscribe button. And when you're at it, also make sure to hit that little thumbs up button, because that greatly helps me with the algorithm. Now, as for the differences between Moolak and Moola Plus, we can see that Moolak Plus just adds a few more retailers to the mix. It also more so incorporates retail or e-commerce, which just gives it a better number. Celsius Holdings now also prefers the Mulo Plus over Moolak, and I can see why, and I think it's justified, even as this gives us a bit of a better view and a bit of a better picture of the business compared to Moolak. Anyway, I think they should use Mulo Plus because it just gives a better representation, also with the incorporated e-commerce and about 15% more retail channels that they track. Now, if you would have taken a good look at Mulo Plus, you could have seen that Red Bull was given in somewhat in terms of market share. And the reason is very simple. And that is because, in my opinion, sugar-free energy drinks are just growing as an industry. They are growing in terms of, sugared energy drinks, and right now they are at 50% of the energy drinks market. This came up from 45.9% in January 2023. So over the past 1.5 years it has gained 5 percentage points almost, which is quite significant, which will hurt Red Bull, but be a positive factor for both Celsius as Monster Energy. Now, if we then look at the gross and operating profit of Celsius Holdings, and more so the margins, we can see that Celsius has a gross margin of around 48 to 52% in the latest quarter, which is quite decent, I would say. It's quite up there. But they have a operating margin of 20 to 23%. We can see on the latest quarter it was 23.4, the quarter before it as well. Now the quarter therefore it was 17, 25.4 and 19.9. So I would say we have an average right here of about 23%. And if we then look at the analyst expectations, we can see a couple of interesting things. We are now expecting Celsius to post 268 million in revenues, which is down 30.4% year over year. So this is a very significant downturn, but we know that this is because Pepsi is underbuying for their inventories by 100 to 120 million. So if we would take out that number, we would see a revenue number of 370 to 390 million, basically. Now, this is a significant downturn, but this is part of their business model because they ship about 50% of their products to Pepsi. Now, in terms of gross profit, we can see 125 million, which is also down 35.6% year over year, but still a 46% gross margin, which is, in my opinion, quite a bit better than I was anticipating myself. Now, we see adjusted EBITDA coming in at 13 million, or down 87% year over year. And we can see adjusted EBIT, so adjusted earnings before interest and tax, at 13 million. Now, I was quite convinced that this number may be turning negative this year, or this quarter, sorry. But analysts have it at a positive 13 million, which is once again down 87%, or only a 4.7% margin, which, I mean, it's quite logical because, of course, you have that downturn in revenues. So the bottom line will also take hard hits with it. Now, adjusted net income only 2 million, or down 97%, which also, once again, it makes sense. It's a very, very big decline. But I mean, that's just what happens. Now we see adjusted EPS at 1 cent, with a high estimate of 2 cents and a low estimate of negative 1 cent. And we see a GAAP EPS expected at 3 cents, with a high estimate of 9 cents, which I think is quite enthusiastic. Just look at the quarter, look at what we are expecting for net income. 9 cents of EPS, in my opinion, is quite high. I mean, if they come in with 9 cents, personally, I would be very, very satisfied. Now, what I'm hoping for is over 5 cents, or 5 cents or over. That would make me very happy. If they beat 9 cents, yeah, that will be absolutely best case scenario in my opinion, because the number is down 89% year over year. Just very, very significant. If we go down even more, we can see that the cash flow per share expected is 9 cents. Now, I was looking at it this morning, and then it was even negative at that time. So now they have some revised analyst expectations, and it's now 9 cents, which is quite good in my opinion. So once again, gross margin 46%, EBIT margin 4.7%, and a net income adjusted margin of 0.5%. Now, if I just put myself to the other side of the screen real quick, you can see that Celsius has become quite a significant holding within my portfolio, as it is now at about 7.6% weighting, which in my opinion is quite significant, but it's very easily explained. Because right here, we are looking at the free cash flow yield for Celsius Holdings. So we take the free cash flow for the past 12 months, so the prior 4 quarters, and we divide that by the market cap, and we get a free cash flow yield of 3.4%, which is quite significantly higher than the market average. Now, if you think that with the growth of Celsius, this should be higher than the market average, well, quite simply, we would disagree. I do not think so. So that gives a great opportunity, in my opinion. Now, where do I think it should be trading? I think it should be trading at around the 1.5 to 2% mark. However, at the same time, we see a forward PE number, a NTM next 12 month PE number of 43.6. And the reason is quite simple. Actually, it's very simple. Because we saw that EPS number that is expected for the coming quarter. That is taking into this number. So that very disappointing EPS number that is expected for this quarter is calculating within this forward PE metric. So going on from Friday, that number will be off the forward PE. All of a sudden, it's 4 decent quarters again, and this number will drastically shift downwards. However, that is only by Friday, and then we will see a better representation of the forward PE. But for now, it's 43.6, and with a company that has been going through such a decline in revenues, I think that quite makes sense. I think purely looking at the decline, and not looking at the reasons as to why, this number should still be high in my opinion. However, we know the reasons why, and therefore we know that this is also a very skewed number. But that brings us to the other company that is reporting their earnings on Tuesday, and that is Elf Beauty. Now, e.l.f. Beauty has seen fantastic and stellar growth over the past quarters. However, in the latest quarter, this all of a sudden slowed down, and this quarter is expected to slow down even more so. Celsius or e.l.f. Beauty themselves guided for 25% revenue growth, but analysts are expecting a bit more. Now, we will look into what analysts are expecting in a second, but first, I want to tell you that I'm expecting e.l.f. Beauty revenues to slow down drastically. I don't think we will see those 50%, 70%, even 80% revenue growth year over year numbers anytime soon. I don't think at all. And the reason for it is quite simple, and it can be best explained by this chart. Because here we see the US beauty market growth estimates from the Ulta Beauty Investor Day. Now, what we can see is that from 2010 to 2019, now that's just behind the frame where I'm sitting right now, we had the US beauty market growing at the low to mid single digits. So, in my opinion, that will be anywhere between 2 to 4%. Now, in 2020, during the pandemic, which is completely behind my frame, the US beauty market shrunk by 2%. Now, in 2021, it grew by 5%, so mid single digits, which is already faster than we've seen from 2010 to 2019. And then in 2022, it grew at about 12%. In 2023, it grew at about 11%. And Ulta Beauty is expecting this growth to normalize back again to the low to mid single digits from 2024 to 2027, basically in that period. And in all honesty, I think so as well. However, the slowing down of the market and therefore also the growth expectations that I have for e.l.f. Beauty does not mean that this company cannot become way bigger or become way better than it is right now. We are looking at the e.l.f. Cosmetics dollar share for their market, and in Q1 2022, we saw that they were the number 5 player at 5% market share. As of Q1 2025, fiscal 2025, they were at 12.3% and the number 2 player. So that is great progress from them. e.l.f. Skin has gone from the number 13 spot to the number 9 spot, as they went from a 2%, or as they now have a 2% market share as the number 9 player, while the number 1 player has 14% market share. So there is very much more market share to gain in skincare. Now, the international net sales growth for e.l.f. Beauty was 91% in the latest quarter. And this can continue growing very rapidly, because if we look at the international penetration for e.l.f. Beauty, this is only at 16%, while the major public beauty peers are at over 70%. So there is a lot of headroom for e.l.f. Beauty to grow that number even further. Now, if we look at the selling prices for e.l.f. Beauty, we can see what I consider their greatest strength. They are cheap. And I mean, they are actually really cheap. But we also know from reports that they have quite good products. Now, their average selling price is around $6.50, while top mass beauty brands sell at an average price of around $9.5. And prestige brands are selling on average over $20. So now this may be looking as if e.l.f. Cosmetics has a lot of pricing power left, but I don't really think they should use it. I think their strength is that they are so cheap, and they should keep using that. Now, in terms of unit volume growth, we once again see something quite special, because this is the year-over-year change in units as of the latest 12 weeks ending on June 15th, 2024, for the color cosmetics category. Now, what we see is that Maybelline is down 8%, L'Oreal, which you also still can see, is down 7%, e.l.f. is up 25%, while CoverGirl is down 8% and Revlon is down 15%. So we see that e.l.f. Beauty is the clear leader there. Now, in terms of unaided awareness, we can see that e.l.f. is making major progress. From 2020 to 2024, they gained 20 points, or went from 13% to 33% unaided brand awareness. And if we compare this to how other beauty companies stack against them, we can see that they are now at 33%, L'Oreal is at 39%, CoverGirl is at 41%, and Maybelline is at 55%. Now, the main argument that e.l.f. Beauty is trying to make here is that they are only 20 years old, while L'Oreal is 114-year-old, CoverGirl is 63 years old, and Maybelline is 109 years old. Now, e.l.f. Beauty also has an incredible membership platform. The Beauty Squad is over 5,000 members, or over 5 million members, I mean, which is also over 5,000, of course. But it had 30% growth year over year, which is simply incredible. And a membership base of 5 million is anything but small, in all honesty. If we look at the adjusted SG&A, this is where I start to have some issues again. Because this went from Q1 2024 of 39% of net sales to 51% of net sales in Q1 2025. And this is in general something I don't like, because I think they are overspending in this area. Now, another reason that might look like overspending is the marketing and digital investment, because this went from 16% to 23% over the same period. However, their marketing works. We have seen that in the growth numbers. We have seen that in the brand awareness of e.l.f. Beauty. So them spending a lot on marketing and digital investments, or just marketing, in my opinion, isn't that much of an issue. However, the SG&A expense, that is very high in my opinion. Now, if we then look at the guidance that e.l.f. Beauty has given us for this quarter, we can see that they had the revenue growth at 25 to 27%, which is a massive slowdown of the 85% we have seen 2 or 3 quarters ago. They went from 85 to 71 to 50%, I think, and now they have guided for 25%. Now we know the game that e.l.f. Beauty is playing. We know that they guide low just in order to beat and raise. That's what they do. They beat and raise. So guiding at 25%, it is very cautious, especially with the growth they have seen. However, I do not expect that growth to continue. Now, if we look at the expectations from analysts, we can see that analysts expect e.l.f. Beauty to post $290 million of revenues, or a growth of 34.3% year over year, which once again is significantly higher than the 25 to 27% e.l.f. has guided for. However, if we move this a bit sideways, I'm just gonna say this already, we can see the downturn in revenue expectations. Because in the coming quarters, we are expecting, or analysts are expecting, I should say, 19%, 17%, 15%, 12%, and 14% revenue growth, which is, once again, a significant slowdown. Now, in terms of gross profit, analysts expect e.l.f. Beauty to post 205 million, or a year-over-year change of 34.6%, at a gross margin of 70%. So that gross margin is looking very, very good for e.l.f. Beauty. We see adjusted EBITDA at 45 million, or a 15% margin, which is looking quite good in my opinion. Now we have adjusted EBIT, adjusted earnings before interest and tax, at 37 million, which is down 31% year over year, as it has a 12.9% margin. Not ideal in my opinion, not really what I would like to see, but still, it's decent. Now, then we have the adjusted net income at 24 million, which in my opinion is quite low at only an 8.3% margin. However, we can see in the coming quarters, this is expected to go back up and slightly normalize again. I would call it normalize again. Now, if we then look at the GAAP EPS, we can see that analysts are expecting 26 cents, which is down 55% year over year. If we scroll it up a bit again, we can see the adjusted EPS at 42%. Now, this is not a really high number in my opinion, but still it's quite okay. Now, if we then scroll down a bit and we do the same for e.l.f. Beauty as we did for Celsius Holdings, we go to the cash flow per share expectation, and this is negative 5%. Now, do be cautious a bit because there's only one analyst who is analyzing or giving us a number for this. So it's not a very normalized number. It's just one analyst who is expecting negative cash flows. However, the free cash flows, in my opinion, is something that Elf Beauty should work on. Because, well, I have complained a lot about this, about the stock buyback program that Elf has approved. 500 million share buyback program, which is very significant for a stock which has a $6 billion market cap. However, I don't think they should use it, and that's especially with how it went, that they blew to 19 million in 2 weeks, while they barely have free cash flow. They barely bring cash to the investor, and now they want to return cash to the investor, which is a bit off in my opinion. So I will be very cautious with how they treated that, because it could be the case, theoretically, it could be the case that they just spent that initial 19 million in buybacks and then went very slow with it. That could be the case. Now, if we then look at the free cash flow yield for Elf Beauty, we can see that it is trading at a 0.67% free cash flow yield, which is very low. That will mean that this is a very aggressively growing company. That is what it implies, right? Because it's very expensive. However, when we look at the expectations for the coming quarters, it simply isn't. 20% is nothing to complain about. Absolutely nothing. But it's not the stellar growth you would expect for a 0.67% market cap or free cash flow yield, I'm sorry. So the free cash flow is something they should absolutely look at and try to work on, because that is something that I just don't like. However, when we look at their profitability on an EPS basis, an earnings per share basis, we can see that the next 12-month PE ratio looks very good. Now, I know this sounds kind of mixed up, EPS, PE. However, the forward PE is of course calculated based on the forward EPS metric. The expected coming 4 quarters EPS is what determines the forward PE ratio. Now, a forward PE ratio of 29.8 does sound very fair in my opinion. A company that is growing at 20% revenue with EPS metrics that are also looking very good. A 30 forward PE looks very good in my opinion. This could be slightly higher even. And the reason I'm saying so is that we can see EPS growth year over year for this year of 10%, which is just not stellar. However, next year it will be 24.6% and 23% expected. And those numbers are really good, especially when we combine it with 28% revenue growth, 17% revenue growth, and 17% revenue growth. They are expected to grow the bottom line faster than the top line. And that is what got me excited about this company. Now, I also hold Elf in my portfolio. However, this is a bit smaller of a holding at 4.47% currently, because I see a bit more issues regarding this business. Also, I'm not quite sure if the issues are over based on the investor expectations for this business. Now, let me know what you think about my views for the earnings of Celsius and Elf Beauty. And with that being said, I want to thank you for watching this video, and I hope to see you in my next one.